I'm Kyle Smith, managing partner for the Bridge Group, joined by Matt Bertuzzi, our director of research and operations. And we're going to run through the 2024 findings of our SaaS AE metrics and compensation report. Spent about the last 6 months compiling and analyzing the data to get it presented and ready for prime time. And so what we'll do now is walk you through some of the key findings and some of the analysis that was done. And for those who don't know, we are probably best known for our research in these reports, but we are a sales consulting organization focused on B2B technology companies. So as we talk through some of the findings and the way that we think about them, that will help to contextualize where we come up with our opinions and the exposure that we have to technology organizations and the go-to-market motion.
Great. Well, this is our ninth iteration of this report. So we started back in 2007. And we've done roughly every other year, so don't check my math there. But basically, every 2 years, we alternate our SaaS AE report and our SDR report. So this year, 2024, is our SDR report. And we had good responses. 172 executives passed the screen where they answered enough questions logically and completely enough that they made it into the data set. 87% of respondents headquartered in North America, a smattering in Europe, South America, and APAC. And then pretty good 47K median ACV, so half below, half above, and 24 million in median annual revenues. So good sizes, good ACVs, good smattering of respondents. For whom they targeted, no huge single buying group dominated. A good others actually pretty large at 7%, a good amount of primary functional areas being targeted. And then if we just stack those functional areas by ACVs, you can see it's not all enterprise InfoSec. It's not all enterprise HR solutions. So there's a good amount of respondents in a wide array of target buying groups and at different price points.
Yeah, and we structured it this way because when we have conversations with either clients, prospects, people who are just reaching out who want to talk more about their data in particular, the things that they're always asking for is, I want other companies who look like mine, revenue, who sell to my buying group, which is what you're seeing here. And what we did is make sure that we teased out that information from our respondents so that we could contextualize everything else that is to come.
All right, there are 5 parts to this report. And the first is kind of like, what are the roles and motions that exist in the organization? So the organizational structure. So marketing contribution. So when we specifically ask respondents when they think of marketing to think marketing leads that go directly to the AEs and marketing leads that go to inbound SDRs, BDRs, and then go to the AEs. So what is marketing contribution? So overall, in 2024, roughly, I think 40% was the median marketing contribution to AE pipeline. Not necessarily to close one, but in theory, it's directionally accurate. And Kyle, correct if I'm wrong, but that's up. That's up pretty big.
Up significantly.
Yeah.
And so when we're seeing a greater percentage of pipeline being sourced by marketing, what that means to us is a greater reliance on AE prospecting against marketing inbound channels. And so those leads that got ignored in 2021, 2022, and the 20 years beforehand, minus recessions, are being focused on. So essentially your pipeline's running lean and you really need to generate net new opportunities. That lead that you got that you used to ignore now is being worked a lot more intensely. And so when you work the lead more effectively, more intensely, then you see they convert at a higher rate. And so all of a sudden that marketing contribution spiked pretty significantly. And you're not seeing the same referral inbounds that once were, where the phone used to just ring for certain sellers, whether from their network, from their customers' networks, whatever. There's less of that. So more of a reliance on the marketing function.
Right. And Kyle and I haven't released it yet, but we have a separate research piece we're doing. And essentially, we looked at 22 to 23. What is the headcount for the median SaaS sales organization? So roughly, it's down, let's say down 12%, down 12 to 6%. So that is also spreading the marketing a little wider, but it's not huge. It's not like there's 40% fewer AEs than there were at this time in 2022. That's just not the case. It's down marginally. So you're getting a few more if you're spreading across, but it's not like reps are getting twice as much marketing as they used to because there's half as many reps. That's just not the case.
Right.
One thing you'll notice throughout our reports is the light blue is 2022 and the dark blue is 2024. So this is just a way for you to see the up. It's up across the board. It's up across all ACVs, the share of AE pipeline sourced by marketing. All right. The next question is, well, what about outbound sales development? So the majority of SaaS companies are supported by outbound sales SDR teams. Something like 65, 68% of all SaaS AE organizations are supported by outbound SDRs. If you take out below 5 million in revenue, and the reason I call that out is they have much fewer degrees of freedom when they have that revenue level. It's hard to have another role. The number goes to about 74, 75%. So across the board, across ACVs, you're going to see the majority of teams are supported by outbound SDRs. There's really, unless you're under 5K, under 5 million, two times out of three, you're going to have SDR support.
Yeah. And then you see one of the interesting phenomenons is over 100K ACV, the percentage drops a little bit. And so 100K deal size, you're going to see almost everyone has an outbound SDR supporting them. And then over, it dips slightly. And so while we don't have the specific data to support it, a couple different ideas as to the why, which is a greater reliance on partners or the channel. And
Yep.
so when you're in big organizations selling big deals, then typically the channel is a more significant factor in where you get your revenue, which could decrease the reliance from what would traditionally be called a SDR. And maybe it's a CAM, a channel account manager, or someone like that, who operates in much the same way, finds opportunities for you to work, but isn't specifically called an SDR. So if you see that little drop off, that's one of the reasons that we've uncovered as to the potential why.
So speaking of the channel, so if we look at the different ACV bands and then break it down into, obviously 100% is the total amount of pipeline, you can see marketing has the lion's share, not the lion's share, the largest share. And then 2022 to 2024, the growth in marketing source was almost proportional to the decrease in outbound SDR support or share. So it wasn't just you, it was everyone. 2022, 2023, or 2023 was tough for outbound SDRs. It was a challenging environment. We saw that across the board. When we start our SDR research this year, we expect to see that reflected in that kind of that median pipeline source number. We expect that to go down, even with a dollar not being what it was 2 years ago.
Yeah. And to me, the takeaway from this one is AE self-sourcing 25% of pipeline. And so the old
100%,
math, the old math used to be, I need 4 million, 5 million in pipelines. It means you need to self-source 1 million in pipeline. That's a good number. That's a healthy
Right.
number, which requires a significant amount of prospecting to go get. So thinking about where your ACV falls on this and what that means in terms of roughly what the expectation should be for self-sourced.
All right. So that's basically find to land. What happens on the renew and expand side? So it's some interesting developments. We linked a few posts here that I thought gave some good context, from some smart people about CSMs. What does it mean versus what it used to, and AMs versus CSMs? But there were a heavy toll on CS teams in whatever headcount reductions happened in 2023. It was disproportional CSMs over AEs, AMs, or SDRs. So resultantly, if groups eliminated their CSM support, then on average, fewer renewal responsibilities would fall to CSMs. So where did they go? Pretty strongly AM support. Like the account management role has come back. It had fallen out of vogue, and when times get tough, it's good to have a person with one job get that renewal, or two jobs get that renewal and get as much net or gross net retention as you can get. So that's where the AM role has really come back on the renewal side. And on the expansion side, same story. Upsell, the AM role has come back, the CSM role has fallen away. And cross-sell, similar story. AM up, CSM down. The only place, Kyle, I saw AEs really owning, renewing, and upselling and cross-selling is in lower revenue companies, which again is a story of how many headcounts can you afford to hire? How many seats can you pay payroll for? All right, section 2. So this is where we talk about teams, ramp, retention, tenure, productivity. But first, where are people hiring? 2020 started a year with, we're hiring for the offices. What are you talking about? And 5 months later, we said, what offices? So 2022, we were still in that we're in a hybrid mode. We kind of want to hire you local, so someday you can come back, but we're not doing that now. And then in our 2024 data, that has shrunk as a percentage of respondents. People are picking a side of the fence.
Yeah.
They're either committing to fully remote or committing to the office, our offices, or actually, like I said, it's either you're coming back or we're just going to go fully remote, but we're not going to do this kind of two-step, but we'll figure it out later.
Yep. No more hybrid, specific to the AE function.
Right.
Or
Absolutely.
sorry, I shouldn't say no more. Significantly less hybrid.
Right.
As Matt said, people picked.
And it's not like it's surprising, actually, when you think about it, that the smaller companies revenue-wise aren't fully remote, right? You would assume, well, if I have budget constraints for hiring reps, it's much cheaper to not have budget constraints for real estate. The story is kind of like almost universal, right? Like the hybrid role is falling and people are deciding fully remote or local to offices. The larger companies who have offices through acquisitions or just HQs, definitely you can see that's like that darker blue, but we didn't have a single respondent in the sub 20 million revenue space who said local to offices.
This aligns to the more anecdotal feedback from conversations with clients, prospects, just people within our industry, where they have largely picked the side.
Yeah.
And so they are either fully in on the remote work and they said, nope, we have no productivity loss. We're good. We figured it out. We worked through all the kinks. We're staying this way. Or they said, we're done with that. It didn't work for us. We haven't ever figured it out. If anything, it got worse over the last 2 years. And we're pulling everybody back in because we need to reestablish culture, process, everything. And so I'm seeing less and less of the hybrid.
Right. You can see it on LinkedIn jobs too. It's like as a search button, you're getting fewer results in that hiring profile. All right. This one is interesting. Like this is the one that really popped for me. Experience required at hire. There was a time, it was just 2022, though it feels like eons ago, where an 18-month or a 30-month experienced rep, someone who was first real professional job out of college, was an SDR, maybe had a job for 6 months, then was an SDR for 18 months, was getting AE roles. With the notable layoffs, not huge, but notable, and with a slowing of hiring, 2023 versus 2021, 2022, there has been a reaction of managers getting choosy. I mean, anyone here who hires knows you can be choosy. You can be choosier on years, on logos they've touched, on profiles they've sold to, on left-handed, right-handed. You can be real choosy now. And
Yeah,
that's
we're back.
reflected in the data.
Yeah, we're back to trying to dial in hiring process in terms of recommendations and things that we're working on. Whereas for the last 2 years, we're working on recruiting. How do we get people to be willing to apply or even take interest in the job? And now what do we do with these 100 applications? And so because you get to take your pick of 100 highly qualified applicants, most of the hiring managers are selecting people with a longer proven track record of success within the role. Less risk for them too.
Yeah.
If you say, hey, I went after a question mark with a high ceiling and you feel like the economy is a little tight and maybe layoffs are on the table, that's a scarier move to make as a hiring manager versus just going with what is closer to what would be considered a sure bet, where you're like, well, that person had all the experience. They're perfect for our industry. So we just went with them. And so companies are hiring for more experience.
So to show you what this looks like versus the olden days, a decade ago, this is the share of companies requiring 3 or more years professional experience at hire. I mean, we're talking, it was a quarter, and then it slowly eked up in the crazy times of the boom times of 2022. That was not an option. You could not be that choosy, but you can see it just rocketed. I mean, this is the highest we've ever seen in the 2024 data. Similarly, or maybe not similarly, a continuation of a long-term trend, ramp time has increased. So this is the share of respondents who reported ramp times in excess of 5 months, which is not a lot from an AE perspective, but keep in mind, you saw the ACVs and the target buyers and the size of companies. This is everybody. Everyone is seeing this slow and steady increase in ramp time.
So you're hiring more experienced people and it is still over time taking them longer to get fully ramped to productivity.
Right. Yeah, that's a good point. Like you'd expect if you were hiring a year more junior, maybe ramp time would go up, but you're hiring a year more senior and you're still seeing an increase.
Challenging selling environment.
For sure. One good news from the company perspective, from our perspective, average tenure rose in 2024. Not surprisingly, I mean, look at this here, the 1 year experience. People are fewer than 12 months tenure. That type of job hopping is statistical noise at this point. Reps are not leaving 2 quarters in to find the next best, better opportunity. You're seeing more sustainable, more normal tenure.
Yeah, the thing that I'm interested to see, is there a bottleneck? Is
Mhm.
there a dam that's ready to break with a bunch of people who have been thinking about making a move but haven't because of the inherent risk that comes with making a leap? Or like you said, all of the SDRs who have been sitting back waiting for
Right.
promotions. And so do we all of a sudden see the floodgates open when tech ultimately has a resurgence hopefully soon? And so does this start to get impacted aggressively in the opposite direction,
Right.
where if we look at this data 2 years from now, 10 years down a full year
Right.
potentially could be interesting.
So putting it all together, we're hiring more senior reps. Ramp time is increasing, but tenure is also increasing. So on the positive side, the increase in tenure time in seat has been larger than the smaller increase in ramp time. So essentially, reps are in seat and productive for longer than they were in the 2024 report. So I think the median is like 2 years. So 2 years of productive time, which is 2 years plus ramp. So if your ramp is 10 months, that is 34 months of tenure and 24 months of productivity. Now, reps do leave. Fewer reps left. And the involuntary means involuntary for the rep. Layoffs or discharges or fires. Involuntary means voluntary for the rep, or aka quits. Like Kyle and I look at the BLS data, the Bureau of Labor Statistics, and the JOLTS report. Quits is essentially the quit rate, or how likely reps are to resign to find the next better thing. And if I had asked you before you had seen this, I think most people would have said, I'm going to guess quits are down, and they are down by nearly half. I mean, 20% quits, 20% of attrition annually, down to 11% to quits, and an increase in involuntary, which could be layoffs, could be being more choosy, could be a number of factors. But total attrition is roughly in that 32% range, which is where it kind of has been for a long-term average. All right, so that is the ramp, retention, and quits data. So now we talk metrics and quota. So these are the numbers that build it up.
So this is
Kyle?
one that I get asked about by sales leaders constantly, which is, what are the activity expectations for an AE? We talk a lot about it for the sales development function, and account executives, it gets ignored until there's a problem.
Right.
Well, currently there's a problem. There's not enough pipeline, so everyone's asking, how much prospecting should account executives actually be doing? This is the data from our report, right? From all the respondents who responded to the report. And so you're looking at 60 median activities per AE per day. And you see the distribution between phone, email, LinkedIn, and other. And so the thing that this does capture is, while the goal is to identify how much prospecting should I be doing, this is overall. So this is going to include all middle of funnel opportunity nurture and closing activities, but 60 per day. That's what you're looking at.
Yep, fair enough. Quotas. This is where things get fun. Okay, so on the left, you can see a large distribution, like almost a normal distribution in the histogram of annual quotas. Some annual quotas are under 300,000 a year, which is not as much as 1.3 million. I mean, that's a wide range. And these are SaaS companies, so it's not like some are selling $1 million of hardware and some are selling $12,000 a year recurring revenue. These are all recurring revenue numbers. So what does that mean? Well, the median is what we think about. Like the median AE has a quota in 2024 of 800,000. If you look at this chart over time, you will see that it has grown at roughly a 2% compounded annual growth rate, which I can't do this math in my head, but let's say that's less than inflation. Let's say $625 in 2012 is probably $825 in 2024. So quotas have not kept up with inflation.
Inflation over that same time period is 2.6.
Yeah.
So you're looking at 2% versus 2.6. So quota increase not keeping pace with inflation over that same 12-year run.
And this doesn't mean, like, if you go on sales Reddit, it doesn't mean people are saying that my territory was halved and my quota was doubled. That does happen, but huge organizations don't do that. You know, if you have 10,000 sellers, it's highly unlikely that you're going down to 5,000 sellers and doubling the quotas, or 20,000 and tripling the quotas. This is the general trend of the industry. By ACV, increases across the board. The larger as a percentage growth, the larger was on the higher ACV end. So you can see it at the smaller ACVs, it's maybe a 5% increase from 2022 to 24. Again, that's not annual. So that's 2 years of inflation that are basically, in real terms, quotas have fallen on the low end, but a really big stretch, double-digit growth on the large end, that 100K and up ACV.
Yeah, big ups for those true enterprise sellers.
Yep.
1.65 million. Big number.
Yeah, big number. And in 2012 or 2007, when we started this, almost unthinkable. That's a big jump in 12 years. It's impressive. We've grown up. We've definitely grown up. Sales cycle, I don't have 2022 data for this. This is something we added recently. But I just wanted to give a sense of the sales cycle in months. And it's like, it depends how big's your deal. How big your deal is, how long your sales cycle. There's some cap chase data that they reported, like a 3.8 week increase across all their companies. So you figure if it's, I don't know, 6-7 months, 4 weeks is just about a month. That's percentage points. It's big increase in sales cycle. I don't think it's surprising to anybody. So win rates. Okay, if we had good news, this is where we talk about things that are a challenge. Win rates fell pretty sharply from 22 to 24. Kyle, do you want to talk about the pipeline coverage? I think that's super interesting.
Yeah, you build the model and you don't know that this is going to happen. And the model is built off of a certain expectation of pipeline coverage. So if I need to go get $1 million per rep, I assume based on historical win rates, I need 4 million in pipeline to go get that million. But what happened is, with the only one change, just win rates, never mind all the other things, shifting from 23 to 19, you need a full another 1x of coverage. And so to get that 1 million, maybe you needed 4, now you need 5.
Right.
And so the model breaks down so quickly just off of the drop off in win rates, which makes it really difficult to try to attempt to close that gap. And that largely pushes back to some of the data presented earlier, where you're seeing AE activity up, AE self-gen up, AE marketing source up, right? So all of a sudden you need way more pipeline and everyone's kicking it into high gear to go get it.
The parallel of a falling win rate is a falling attainment rate. One would not expect in that challenging environment that the same number of reps made quota as did in prior years. So again, the lighter blue is 2022, the darker blue is 2024. And you can see, so the below 50%, 26% of respondents in 2022 said fewer than half their reps made quota. 37% of reps said fewer than half their reps made quota in 2024. I mean, in every band, the shift has been up. So more reps achieving less quota. This is probably the most clear way to see it is, once upon a time in the Goldilocks era, let's say high 60s was reasonable, low 70s maybe was a slight outlier, but high 60s is what you expected. 2/3 of reps making the number means that the median rep hits quota and the team exceeds quota.
Yeah.
That's generally the shape.
Yeah, my personal opinion is that high 60, 66, 67, 68, somewhere in there is a perfectly designed compensation plan. 66 to 68% of your team achieves quota. The team overall makes the number, and you have some people who are dramatically outperforming and making great money. At 74%, like 2012, quota was probably a little too low. You're probably not getting people to stretch as much, maybe overpaying for the production. 51% too low, right? Like then you're going to have significant morale impacts, and you miss the number. There's no way 51% of the team can be at or above quota and have the team overall achieve it. It just
Right.
doesn't happen. Those underperformers are going to ensure that the team misses the big team number.
Yep, absolutely. So keep that number in mind because we're going to talk about compensation next. And when you see OTE, don't forget the T stands for target. And if not, if only 51% of reps are at or above target, what does that mean for the OTE or the OTE? So comp is up. Now this one does track inflation a little tighter. Actually, it's almost double inflation if you take Kyle's 2.6% number.
Yep.
This is a 5% compounded annual growth rate in median A on target earnings over more than a decade, 12 years. So the median plan we saw in our data was a slight shift, not a 50-50, but a, I don't know, 55-45, let's say, of 100K base and 90K variable. So 190 OTE on target earnings of 190.
Yeah, interesting for both the AE role that we're looking at and the SDR role. The trend seems to be a shift towards base.
Yeah.
Like, yeah, I know it's up. It's basically always going to go up, but seeing a greater percentage of the on-target earnings going to the base comp is interesting. So I thought it was 50-50 forever. I thought that was just the standard for an account executive, but 53-47, while not a huge shift, that means that some companies are at 60-40.
Yeah, absolutely.
Right?
No, that's
So
a great point. Right. Yeah. A good amount of companies are at 60-40 to pull the median the whole way over.
right. So it's interesting. More on base.
So what does that mean by ACV? Obviously, as one would expect, if my quota was 300,000, my OT might be 148, which is actually a pretty amazing ratio. When you think about it,
Yeah.
amazing from a rep perspective. And then if my quota is 1.6 million or whatever on the high end, and my OTE is 300, that is a less excellent ratio from the rep perspective.
Yeah. And you see it's really tight groupings with those lower or sub 50K deal sizes, 148 to 180. So there's certain escalations that you can make as you move into middle market, maybe, but jumping up into those enterprise deals, the 100K plus is really where we see the earning potential skyrocket.
Yep.
And it's not overly surprising, but it's always interesting to just see how the numbers actually play out.
Yep. So ratios, this is where if we look at if we take every row, every plan, and we have their quota and we have their OTE and we just do the math, what is the median quota to, what's the median multiple of OTE that is the quota? So 4.2 is the number. So if my plan is 200, if the median plan is 200, which it isn't, but it's easier math for me, and it's the median quota is 4.2, that would be 840.
Yep.
Yeah. So basically 190, 800. Right.
Yeah.
That's the ratio. So 4x.
Yeah. OTE times 4.2 equals quota.
Right. Which is a more reasonable ratio than what we saw in 2022.
If people are off of that, why? What are some of the reasons why the multiple would fall above or below that?
Well, if let's say it's again 800, or let's say it's 750. If we're paying somebody 750, or sorry, their quota is 750 and they're making 200, the ratio is going to be much lower.
Yep.
If they're underpaying relative to the market, then the ratio is going to be much higher. But the band is really like 3.5 to 4.5 is kind of where you want to be. That's just rough, good math on, is my quota right size, or sorry, say it a different way. Is my comp a reasonable multiple of the reps quota?
Yep. Yeah. And the only outliers that I see typically is two ends of the spectrum. One, no resources whatsoever.
Right.
No SDR support, no marketing, no brand, still basically trying to find product market fit. And then the multiple is going to be way lower because you are truly generating every single dollar and the company is doing less of the heavy lifting.
That could be a 300, 150 scenario.
Exactly. And then on the other end of the spectrum, where massive brand, reputation, inbound lead funnel, well-developed outbound channel, and partner network and referrals, then all of a sudden it starts to flex up to a higher ratio. But for the majority of the companies that both responded and that we work with is a good benchmark.
All right. So this is actually interesting. We know that OTEs have increased over time at roughly 5% compounded annual growth. And we know that the share of base has grown, which means that the share of variable has shrunk. And we know that quotas have grown, but they have not grown at 5%. They've grown at 2%. So this is like the big squeeze. This is what is the median commission rate and how does that compare to what we used to pay? And obviously the median commission rate is higher because OTEs have gone up, quotas have gone up less sharply, and the ratio is slightly more base. So the variable pool is even smaller. So this is like 3 percentage points, 3 percentage points in 12 years toward the reps' favor at on target.
Yeah, back of the napkin math, reps used to always just assume, yeah, I get 10% of the deal. And
it was
just
8% when I was a rep. I remember one month, 8%. Well, a month is not 8%, but it was felt like 8%.
Yeah. And yeah, so it's 10%, and the data shows you essentially 10%, and then that sharp uptick that Matt just talked about, 11.5.
Yeah, be very interesting to see where things go. Be very interesting to see where things go.
Yep.
And then finally, we want to talk about leadership. And again, these are on target. So if 51% of reps are making their number, I would be shocked if managers are making their number. That's an impressive plan. But basically, the compounded annual growth rates, it's less than reps, 4.2% versus 5%, but it's well more than quotas, 4.2% versus 2.6% or 2%. But at the higher end, director, and this is cash compensation. This is W-2 compensation, not to count RSUs or ISOs or sign-on bonuses or what have you. But this is roughly managers, which one might not be surprised at. It's probably a tougher environment hiring for managers. There's a lot of people who are first-time managers looking to become second-time managers, or reps looking to become managers. And at the director and VP level, it's basically comparable. The increases in comp for directors and VPs are the same as they are for AEs. Big numbers.
And so based on how your numbers stack up to this, we're always happy to respond to questions to either further clarify the data as it's been laid out or talk through your situation in particular. So everyone always likes the specifics about, okay, well, what does this mean for me? Well, we love talking about it. So if you want to talk through not just what are the numbers in this benchmarking report telling you as they compare to your own, but also want to understand the why behind potential divergence from benchmark, we're here. We can talk about it. This is all we do. We live the go-to-market motion for B2B technology organizations.
Hey, everybody. Thanks so much.